Datavault AI Inc., trading on the NASDAQ under the symbol DVLT, is changing hands right now at exactly $0.4244 per share, reflecting a minor intraday dip of 0.37% as the session moves along. Volume is sitting at roughly 32.55 million shares against its hefty 55.76 million average, pointing to a market that is closely watching, calculating, and trying to decide whether this micro-cap player is a major bargain or an asymmetrical trap. While everyday market spectators look at that price and see nothing more than a volatile sub-dollar software play bouncing around in the after-hour shadows, institutional money is dissecting a massive corporate restructuring that happened just months ago. In early 2025, the company abandoned its old life as WISA Technologies, shedding its pure-play consumer electronics skin to emerge as a rebranded data valuation powerhouse. This is not just a cosmetic modification. The real underlying narrative here centers on a freshly signed $2 billion structured financing term sheet with an exclusive global tokenization mandate announced at the start of June 2026. This massive financing framework turns the retail perception of a struggling penny stock completely on its head, proving that behind the retail trading screens, heavy institutional machinations are taking place. If you ask the average online trading community about this business, you will hear a very straightforward, conventional consensus. Retail traders using standard self-investing applications often assume this is just another generic entity slapping an artificial intelligence label onto its name to chase the massive macro trends of the current economic cycle. The typical narrative says that microcap technology microcaps are highly speculative, deeply diluted, and too risky for anything outside of a quick swing trade on a volatile morning. People look at the historical balance sheet problems and assume that without massive share dilution, companies in this tier cannot survive the high operational costs of sustaining data science platforms. But when you separate the surface noise from structural realities, a much more complicated situation comes into focus. Look past the simple screeners on common investing sites, and you find an organization that completed a massive asset purchase from Datavault Holdings, fundamentally altering its core asset base. By integrating high-performance computing platforms with specialized data science agents like DataScore and DataValue, they are building an infrastructure that prices and structures enterprise corporate data as a liquid balance sheet asset. This changes the conversation entirely. While the crowd treats it like an old, fading semiconductor brand, the underlying operational machinery is positioning itself to capture the massive demand for secure, corporate metadata clearinghouses. To fully understand why the stock is experiencing these daily microswings, we have to trace the immediate technical indicators, order flow patterns, and institutional positioning shaping the current tape. The stock has been trading well below its 52-week high of $4.10, establishing a firm floor near its 52-week low of 25 cents. This compression has created a coiled spring technical setup where short-term daily movements are dictated by aggressive liquidity sweeps. When retail buyers jump onto their Robinhood stock trading app or utilize Robinhood fractional shares to accumulate small positions, they are interacting with high-frequency market maker algorithms that thrive on this exact level of sub-dollar asset volatility. The daily trading volume shows a clear pattern of accumulation days, followed by long periods of low-volume consolidation, highlighting that larger, quiet entities are building positions without triggering massive upward momentum that would spoil their average entry price. At the exact same time, look at how the short interest and legal tracking are creating a natural friction in the stock price. Just this week, prominent legal groups launched investigations into whether the executive teams fully complied with securities disclosures, a direct fallout from legacy short reports that criticize the rapid shift towards blockchain marketplaces and digital asset tokenization. This ongoing friction keeps the broader market hesitant, suppressing the stock price and keeping it confined to this narrow microcap territory. While standard individual brokerage accounts might panic when seeing law firm headlines cross the ticker feed, seasoned institutional players view these structural battles as typical cleanup phases after a major reverse merger or corporate pivot. The trading platform order books show significant blocks of shares being held tight, suggesting that despite the retail public's nervous sentiment, the underlying float is being concentrated among believers who look at multi-million-dollar revenue guidance targets instead of short-term headline risk. To evaluate where this asset fits into a broader macro perspective, it is useful to look at how retail wealth management models approach high-growth software allocations. Investors setting up automated setups like Schwab Intelligent Portfolios or browsing curated lists on major online investing portals rarely find microcap assets like this because automated systems require massive market caps and deep liquidity profiles. Instead, this is the type of active risk that requires specialized self-investing tactics or direct involvement through advanced professional interactive brokers trading platforms. When you look
look at the strict risk parameters of a standard intelligent portfolio, assets under 50 cents are filtered out automatically, which means the natural buying pressure does not come from passive index funds or massive retirement target date products. It comes from concentrated, speculative portfolios where the investor is willing to accept high beta in exchange for asymmetrical upside potential. If you glance at how larger legacy financial institutions deal with this sector, you can see a distinct line between passive retail index products and active individual brokerage decisions. For instance, looking across the vast landscape of premium investment options like Fidelity Investments, Fidelity ETFs, or Standard Fidelity mutual funds, you will notice that deep institutional holdings are generally focused on large-cap technology platforms. A micro-cap asset like this rarely makes its way into a Standard Fidelity brokerage portfolio unless an individual trader explicitly seeks it out via the Fidelity mobile app or places a manual order on the core Fidelity trading platform. These platforms are designed to provide massive, stable investment help to the broader public, prioritizing billion-dollar balance sheets over highly volatile data science microcaps. Yet, when an active speculator wants to step away from the slow, predictable path of traditional wealth preservation, they look for overlooked, restructured corporate shells that possess unique, globally patented intellectual property assets. Let us zoom out for a second and look at exactly what this company does to generate its top-line figures. Originally known for wireless audio standards and multi-channel sound transmission through their WISA brands, the modern corporate entity operates two highly distinct divisions, acoustic science and data science. The acoustic side still provides foundational technology for premium home entertainment and wireless audio experiences, ensuring precise synchronization and interference cancellation across hardware setups. But the real growth engine, the piece that explains the sudden name change, is the data science segment. This division focuses on creating automated tools that calculate the precise financial value of enterprise information, allowing corporations to treat their internal data logs as real-world assets that can be tokenized, secured, and sold to third parties without violating strict international privacy regulations. Their business model centers heavily on software licensing fees, high-performance computing allocations, and partnership integrations with major enterprise tech giants like IBM. By incorporating corporate AI suites like watsonx, they provide a secure layer where large corporations can run advanced modeling and pricing strategies without risking compliance violations. This means they are acting as a specialized middleware layer for a corporate landscape that is desperate to monetize digital footprints, but deeply terrified of regulatory penalties. They have even expanded into niche digital identity validation systems and credential verification networks for academic and corporate entities, aiming to secure individual records on immutable digital ledgers. Please take a moment right now to participate in our channel data tracking. Comment below how many shares of Datavault AI Inc. you currently hold in your portfolio, and let us know if you bought them before or after the official corporate name change from WISA Technologies. When we evaluate the financial performance reported over the recent quarterly cycles, the absolute tension between market expectations and corporate reality becomes undeniable. Looking closely at the financial data available through advanced interactive brokers platform analysis, the company's revenue profile has shown massive quarterly swings. In late 2025, they posted a massive top-line surge of over $33 million, which caught the entire street by surprise and triggered intense speculative interest across online investing channels. However, the subsequent quarter in early 2026 pulled back sharply to roughly $3.5 million, illustrating the highly uneven, contract-driven nature of enterprise software licensing models. Operating expenses have climbed significantly, driven by a sharp rise in research and development costs, along with heavy selling and general administrative expenses as they aggressively scale their data science sales teams. This financial profile explains why the stock remains highly volatile and sensitive to immediate capital injections. The company is currently operating with a negative net income profile, meaning it is burning through cash to secure its market footprint before its recurring software licenses can fully cover its overhead. For an investor managing a self-investing account through a Robinhood app setup or an active SoFi Invest portal, this creates a major decision point. The company has reiterated its full-year 2026 revenue target of at least $200 million, which would represent a staggering 400% year-over-year growth rate if achieved. If the company hits that target, the current sub-dollar share price will look like an absurd valuation anomaly. If they miss it due to delayed contracts or integration friction, the ongoing cash burn will force further equity dilution. This is exactly where the balance sheet realities conflict with the grand narrative found on popular investing sites. Speculative buyers often overlook the structural debt and share dilution that typically plagues microcap transitions. Over the past 12 months, the total shares outstanding have expanded significantly as the company used equity to fund its high-tech asset acquisitions and maintain its listing requirements on the NASDAQ. This dilution means that even if the total enterprise value of the data platforms expands, individual shareholders own a smaller piece of the total pie than they did a year ago. It is a critical factor that anyone utilizing interactive brokers trading or browsing active ideas on SoFi stocks must keep in the front of their mind when sizing their positions. Looking forward into the second half of 2026 and beyond, there are two distinct scenarios that could play out for this asset, each depending entirely on how corporate expectation matches up with operational reality. In the bullish scenario, the newly signed $2 billion structured financing framework functions exactly as intended, providing the company with an immense non-dilutable capital runway to scale its high-performance computing infrastructure. As more enterprises adopt the data score and data value models to audit their corporate assets, the high-margin recurring licensing fees will start hitting the balance sheet, allowing the firm to rapidly converge on profitability and easily meet its $200 million full-year guidance. This would cause a massive short squeeze and a structural re-rating of the stock, lifting it out of the penny stock basement and back into compliance territory where traditional wealth management systems could comfortably buy it. The bearish scenario, however, is a harsh reminder of the risks inherent in microcap technology plays. If ongoing shareholder lawsuits and regulatory investigations create structural gridlock, or if the integration of the newly acquired digital asset platforms takes longer than expected, the company could experience a costly slowdown in new client acquisition. If enterprise buyers hesitate to trust an organization caught in legal crosshairs, the revenue recognition will stall, forcing the executive team to execute further equity financing rounds or face severe liquidity pressures. For active traders tracking the stock on interactive brokers' fee sheets or monitoring their balances across SoFi active investing accounts, this means that strict risk management and precise position sizing are absolutely mandatory to survive the potential downside. To cleanly summarize what we are looking at with Datavault AI Inc., the entire asset is defined by a massive gap between what the broader retail market thinks it is buying and what the corporate balance sheet actually shows. The public looks at a volatile 42-cent stock and sees a highly speculative, risky software play that is constantly fighting legacy capital